Ever feel like you're drowning in information, like you just want to cut through all the noise and really understand a topic? Well, that's what we're doing today.
Yeah, absolutely. And the topic we're diving into is venture capital, trying to get a sense of how the whole model is evolving and what might be coming next.
Right. Especially with all the market shifts we've seen lately.
Yeah.
So to do that, we've gathered a bunch of sources, reports, analyses, all that, spanning from 2020 to, well, very recently, late 2024.
A lot has happened in those few years.
Definitely. And what we really want to get a handle on is, well, how has the venture capital landscape changed? How is capital being deployed? What strategies are being used? What are the fundraising trends? And there's this really interesting pattern that pops up in VC, this kind of cycle.
Yeah, I know what you mean. It's like periods of innovation where people are trying all sorts of new things.
Exactly. And then things kind of swing back.
Everyone retreats back to the traditional ways of doing things.
Precisely. So the big question we're going to try to unpack today is whether this time, right now, might actually be different. Could this be a moment where VC breaks free from that cycle?
It's a great question. And honestly, I think the sources we have point to some pretty compelling arguments on both sides.
Okay, so let's dive in. It seems like one of the key drivers of this back and forth in venture capital is the availability of capital.
Oh, absolutely. A 2020 analysis really hit the nail on the head, pointing out that when there's a ton of capital sloshing around, just being able to get into deals to get access, it's not enough.
It's like the rising tide lifts all boat situation.
Exactly. Everyone benefits, but the returns, the actual profits, well, they might not be that impressive. Traditional venture strategies, they get kind of saturated during those times, right? Everyone's piling into the same kinds of deals.
Leading to, I guess, search for something new?
For sure. And that's when you start seeing experimentation, right?
Right.
Investors are hunting for ways to generate better risk-adjusted returns. It's not just about getting a piece of the action anymore. It's about finding smarter ways to bet, to actually outperform the market.
So when you have this flood of capital, what are some of the new approaches that tend to emerge?
Well, there's a really interesting 2021 report that laid out what they called 4 key shifts in venture capital. First, there's democratization, more diverse groups of people getting involved in investing, which is great to see.
Okay, so broadening the pool of investors. What else?
Then there's this focus on deal growth, a real emphasis on helping companies scale up, become truly significant businesses.
Got it. So not just early stage investments.
Yeah, it's about supporting companies through various stages of growth, and then you have diversification, spreading investments across a wider range of sectors, maybe going beyond the usual tech hotspots, looking at different regions too. And finally, there's digitization.
Which basically means using data more effectively, right?
Exactly, leveraging all that information to make smarter investment decisions. So you can see there's this whole wave of new investment instruments, different risk profiles, a willingness to explore new areas. It's really quite dynamic.
But as you alluded to earlier, this period of experimentation, it doesn't always stick around.
Unfortunately, that's often the case. When the market shifts, maybe things get a little tighter, there's this tendency for limited partners, the LPs who provide the capital for venture funds, to get a little, well, risk averse.
Makes sense, right? When things are uncertain, you go back to what you know.
Exactly. And that usually means favoring those established, well-known firms, the ones with a proven track record.
And there's data to back this up.
Oh, yeah. The 2024 PitchBook data, the Venture Monitor report, it shows that almost 80% of the capital raised went to these big, established players, the highest concentration in a decade.
Wow, that's a huge shift.
It really is. And it has some pretty significant consequences. Well, these newer investment firms, the ones that might have really innovative approaches, even if they're performing well, they can get swept up in this movement back towards the familiar.
And get lost in the shuffle.
In a way. They might even be unfairly lumped in with more speculative ventures, the kind that were riding a hype wave but maybe didn't have the substance to back it up.
So even if they have a solid strategy, they might struggle to get funding.
Absolutely. And it can really stifle innovation in the venture capital space.
Yeah.
It makes you wonder if this boom and bust cycle, this constant shift between innovation and a retreat to tradition, if it's just, well, inevitable.
Right, like it's baked into the DNA of venture capital. However, one source suggests that this time may be different. Could you elaborate on that?
Yeah, this is where things get really interesting. You see, the current environment, what some are calling the new regime, it's putting a lot of pressure on smaller and emerging VCs.
In what way?
Well, deal counts are down. There's simply fewer deals happening, even with all the excitement around artificial intelligence. And yet there's still a ton of dry powder, uninvested capital just sitting there.
So a lot of money waiting to be deployed, but fewer opportunities to deploy it.
Precisely. And that creates a fiercely competitive landscape, especially for new funds trying to break in. It's tough to even get a foot in the door.
So it sounds pretty bleak for these smaller players.
Well, it's definitely challenging, but it's not all doom and gloom. In fact, our sources point to a potential silver lining.
Really? What is it?
You see, the rise of these giant, multi-stage venture banks, these firms that invest across all sorts of stages and sectors, it's actually creating an opportunity for smaller, more specialized firms to differentiate themselves.
How so?
Well, these smaller GPs, they don't have the same pressure from those huge LPs to chase every hot trend, to constantly go after the biggest, most hyped up
So
deals.
they can be more selective, more focused.
Exactly. They can focus on building a consistent, process-driven approach to finding and supporting promising companies, aiming for steady, reliable returns, maybe not the explosive growth that some of those mega funds are chasing.
It's almost like a back to basics approach, right?
Right.
Focusing on the fundamentals.
In a way, yeah. And it's interesting because there's this 2022 source that was quite critical of the traditional venture fund model and the funding process itself, arguing that they're actually contributing to underperformance.
And so maybe this shakeup is a good thing, forcing a much-needed evolution.
That's the potential upside. These recent challenges, even though they've been difficult, they might be pushing these newer VCs toward a more resilient, more sustainable way of operating.
So to sum it up, it seems like while venture capital has always gone through these cycles of innovation and then a retreat to the familiar, the current market pressures might be forcing a more fundamental and lasting change among emerging VCs.
I think that's a really good way to put it, and it raises a fascinating question, one that I think our listeners should really ponder.
Okay, let's hear it.
Considering all these dynamics, all these shifts in the venture capital landscape, what core aspects of the model, the things we consider fundamental to how VC works, what might be permanently transformed in the coming years? Will we see changes that go beyond those cyclical ups and downs, changes that actually stick? That's the question I'd leave everyone with.
Yeah, that's a great point to think about. And thanks for taking this deep dive with us.
My pleasure.
And to all our listeners, keep learning, keep exploring, and we'll catch you next time.